Good morning. It's Peter Klein, Chief Investment Officer, ALINE Wealth, here with you on the 26th of January, 2022, at about 11 o'clock in the morning. So this is Fed Day. So the Federal Reserve will commence its meeting, its two-day meeting, and have a statement about 2:15 this afternoon. So this program, this discussion, market conditions, economic conditions, is before that meeting. So that's important. Markets have certainly been volatile as of late, as we had expected. Note our December 27th write-up about the markets. And in there you will see our concerns about valuations, frothiness, market conditions. So let us go today and talk a little bit more about what we're seeing, what's the framework, and how best to navigate those twists and turns through the market system. I'm sharing my screen with you, so bear with me. Here we go, and we're off to the races. So the first thing I want to show you are those twists and turns. As you can see here, the twists and turns of the capital markets of life. And at ALINE Wealth, what we're trying to do is to get you on that road, to keep you on that road, to serve as guardrails, to keep your objectives in focus, even in a bad turn here and there. We're going to keep you on the road and keep you to your objectives and going forward. So we proceed. Today's agenda, we have our discussion of the current situation, the tale of the tape, the economic conditions, as well as internals in the market as well. So all of that is in the discussion for today, valuations and where to position going forward. So let me start with this. This is the look at GDP, and as you can see, we've seen a marked change in the velocity of growth that we've seen both in GDP as well as in earnings for 2022, largely due to the lack of stimulus that we're likely not to have going forward. You can see here the Fed's balance sheet. And you can see how it ballooned during COVID. And this is a concern, as you'll see, because obviously there's a lot of debt in the system. And interestingly, this is the great financial crisis. Seems like a nothing compared to what we've gone through. With all of this stimulus, with all of this debt coming in, the question is, what happens to rates? How do you pay off the debt? What happens when it's normalized? That's what's going to happen today in the 2:15 Fed meeting. They're going to talk about normalizing this, taking it away, reducing stimulus. That's going to have implications. Here's the same chart. Here's the green is the Fed's balance sheet, and here's the markets, right? Here's the S&P and the NASDAQ. You can see a perfect linkage to Fed, the Fed and markets. So the question that is begged is, if the Fed's pulling back, what's going to happen to the market? How are they going to be able to? Will they be able to sustain the same amount of upward trajectory than they have been? And if you think rates are not going up, folks, think again. Here's a wage growth and the Fed funds rate. How can you have wage growth, which is quite inflationary if you think about it? Once you get an increased wage, it's not like you're going to take it back next month, next 6 months. So that propagates more inflation, because what happens is that now the labor has more capital to spend, so they're spending more and everything goes up accordingly. So this is telling me and telling us that we're thinking that rates are likely to go higher. 3, 4, 5 hikes this year, unsure. We'll know later a bit more, I suspect. Again, this shows you that huge bond market rally since 1980s to now, and it's over. The bond market rally is over. So, we're not really fans of bonds in here. I mean, of course, there are idiosyncratic one-off opportunities along the way, but for the most part, we see that asset class is not really bringing much to the table, and with a considerable amount of risk. And you can see with this huge bond market rally, with the decrease in interest rates over the last 40 years, look what's happened to operating margins. Well, that's going to change. So here's some internals. Here are the different pullbacks that we've seen just in the last 2 years. And what's interesting is that besides this big one during COVID in March of 2020, the others have been fairly benign. That's not typical. Usually in a 2-year period, you get a bit more of the 10 to 20, maybe even a couple of 5 to 10s. You've gotten a couple of those, but certainly not much of these, and not any of these. So I think we're overdue, and that's healthy, right? You want to have that. We welcome volatility. It allows us to to implement portfolios at lower prices. Here is the concentration, or breadth as we call it, and you can see here that the largest companies in the S&P was the largest ever, near record high. And you can see here, these are the most largest stocks and how they've been, sort of controlling the entire index. Well, this is talking about how the ARK and other related, we'll call them high multiple tech stocks and high multiple new age companies have done in the last few months, and they've come down dramatically, and they're still coming down. This is as of December. So what that tells us is maybe now that the speculative frothiness has deflated somewhat, maybe the next thing to happen, the next domino, so to speak, to fall are the bigger companies. Or on the other side of the coin, perhaps that's it. Perhaps that, the fact that we were able to deflate the bubble of speculative froth without infecting the rest of the economy or market is a positive thing for the market. So we're not sure of that yet. I think a lot of it has to do with interest rates and the Fed and inflation. We'll see. It's a moving target. Okay, and here's some more of this speculation with crypto coming down and fintech. So speculation has not been a winning strategy, not one that we ever adopt, frankly. So these are the kinds of stocks that have no earnings, right? And we saw that recently. This is from last month. We talked about how many of these companies without any earnings have been the darlings of Wall Street. Well, that can't last, although it was hard betting against it for a while. So that's changed a bit. Sentiment, again, everyone was pretty optimistic. It's changed a little bit today. We're seeing less optimism. And so the fear and greed index has changed a little bit. I'm just going to move this over here. Bear with me. And so now we're seeing a bit more, pessimism in the market, given what we've seen in the last few weeks. So that makes sense. There are new eras, no new eras, right? Markets will always move in cycles. The mean reversion, that's the most important tenet of finance, right? Mean reversion. And that means we move from one extreme to another. Think of the pendulum. And perhaps we were too high on one side, and now we're going and correcting, but it's likely to go too down or too much on the other side, too much pessimism, right? And that's where you want to be sort of a buyer, right? So it's a case of human nature, two extremes, one for the other. And, the pressure on the Fed to do something, if indeed we were to have an overly pessimistic market, might be interesting. I don't know where that is. I don't know what their pain point is. But I would be the first to look at adding pretty aggressively to equities if we were to have a pretty substantial decline, not like we've seen thus far. I mean, that's, maybe it's a beginning, maybe it's not, but keep your powder dry, folks, and wait for that, the white of their eyes, so to speak, and wait for that proverbial fat pitch, so to speak. And at that point, I think we can get in there and get in there aggressively. Okay, so here's a graph that also speaks to sentiment, in the sense that now we're looking at how much folks have in equities. This is the most they've ever had in equities. So everybody's in the pool. Everyone's investing. And essentially, it's even more than their equity in their house, the first time ever. Was close over here. Oh, that was also a bubble. So therein lies, when you're seeing everyone in the pool, it's time to get a little bit worried. Valuation, we always talk about valuations at Align Wealth. It's part of what we do. It's part of our proprietary dashboard of metrics we look at. Here is the Wilshire to gross to best. This is the Buffett indicator, right? This is Warren Buffett's favorite indicator. Think of it as a big fat PE ratio, where the price is the entire market of stocks, and the earnings is the GDP, right? And look at it, all-time highs. Here is tangible book value, all-time high. Here's price to sales, parabolic, very risky. And this is what's come down a lot. A lot of those companies that were trading at 30, 40, 50 times sales, ridiculous. Now, the rationalization of this all-time high or almost all-time high CAPE, remember the CAPE is the cyclically adjusted PE, smooth out the PE over 10 years, essentially. Robert Schiller from Yale, Nobel laureate, his work. And what he's showing here is that we're about 40x, and you know, it was not as high as 2000. There was some talk that it may have been as high as this at one point. But regardless, the fuel that many folks are saying to this higher valuation, the rationalization of it, is this notion that interest rates have come down considerably. And with interest rates coming down, you're seeing more and more you know, opportunity for higher multiples. Well, guess what? The bond market rally is over, right? So we're tending to think we're going to see higher interest rates over the next few years, and then how do you rationalize it? That's the point. The rule of 20 is an interesting thing. Think of PE ratio plus inflation, and it's supposed to be below 20. Well, it is not. It's above 20 now because our PE is probably more than 20. It's 20.8 on a forward basis. It's probably 22, 23 on a trailing basis. Add inflation, what's that, 6-7% on the recent CPI? A good deal above 20. But what I want to show here is the disconnect between earnings. Sure, they went up sharply after COVID, but look at the market, right? And usually you see a tighter correlation. We call that R squared, or correlation. Tighter correlation. Here's a gap, and that's the gap of froth, right? That's the gap of speculation. And that's the gap we don't get involved in, because that's where, you know, major problems occur. Okay, opportunities, because we're always looking for opportunities. Yes, we're concerned. Yes, we're cautious. Yes, we think there's some issues out there, clearly. However, and we've been writing about that for some couple of months now. However, as you know, we're also in the business of investing our clients' capital in a very methodical and fiduciary-centric way. So we put together a 5-step thematic acronym, 4 I's and a V, and it's inflation-centric assets, real assets, right? We want to have some commodity exposure, some lumber exposure. We want to have a real asset exposure. We believe inflation is going to be a bit more pervasive than others might think. And therefore, we don't want to have too much in the way of fixed income. International, we see that as an opportunity. Much lower valuations, strong companies, historically solid businesses, and yet trading for a fraction of what the U.S. counterparts are. And, you know, if you look at the, you know, sort of yin and yang between international and non-international, we have a slide on it, you know, U.S. versus non-U.S. It's always like sort of an up and down every couple of year cycle, and it hasn't been. It's been U.S. all day since 08. So international is overdue. Infrastructure is our third eye. We definitely want to be involved in the build out of infrastructure. There's a wind at the back, a tailwind, due to the infrastructure bill that was just passed. $50 billion going into water and water related infrastructure, canals, pipes, pumps, lead remediation, a lot of good stuff. A lot of important things are happening. Those companies are going to see more and more growth. And then you've got 5G and the rollout thereof. So there's a lot of interesting things in the infrastructure space. Innovation, while we're cautious, we do not want to give up on innovation. However, we believe the strongest innovative opportunities are in life sciences. We believe in the golden age of medicine. Just think about what happened in 11 months in 2020, from the onslaught of COVID to the vaccine. Brilliant, amazing. You never get it, you know, I mean, it's just, you know, it took years for that to happen in the past. And now with the intersection of raw computer power and speed, coupled with the genome map, we are going to see, hopefully, disease after disease knocked off. Unfortunately, there'll probably be others discovered. The point is, golden age of medicine, that's the innovation we want to be involved in. And we have a whole bunch of interesting companies in that field. And then finally, value over growth. And we'll see some slides on that. So here's the I want to just make sure I show you this, because I don't want you guys to think that because we're tactical and active and mindful of the markets and the allocations of our clients, that does not mean that we're traders. We're not. Okay, we're balancers. We're asset allocators. We're always going to have our portfolios, but around the edges of those portfolios, we might add or subtract exposure. We may add or subtract different asset class exposure. That's being mindful. That's being proactive. What would you like us to do? Sit on our hands and hope and pray things go well? That's not a strategy. So you want us to be proactive, but not timers, because you see here, timing doesn't really work. We're not bettors on speculators. Look at this. I mean, for how many years is this? It's 27 years. If you were just to miss the best 30, you're down to 2% versus 8.7. That's a huge difference. We're not playing that game. We'll be maybe not fully invested, but we'll be invested according to your risk tolerance, and then work the edges. And in fact, we could argue sometimes working those edges, finding those special situations, investing in the right asset classes at the right time could make a big difference. This is an important thing to look at, because we're showing that over the decade of 2009, after the crash of 2000, that was a lost decade. The market actually lost 9% a year on average over that period of time. Now, this is cumulative, 9% cumulative, right? But in that same lost decade for the S&P, look at this: European stocks, mid caps, high yield, emerging markets. So we're picking these two out because we like these two going forward. So even in a flat to down S&P decade, there are still things to do. That's the point. And this, the Widowmaker, which is the global value, that's been a difficult place to be in the last few years, 10 years, I think is now a place to be. So we're looking at international and value, as you know from our acronym, and we think that's an opportunity. European stocks look like they're very interesting here. You know, they look like they're breaking out. So we like Europe, and we like emerging as well. Japan is the anti-momentum trade. If you can see here, Japanese market is the lowest when it comes to breaking out to new highs. So we think Japan is really interesting. And if you look at a chart, looking at Japan 1989, I wrote about this last month, to now, it's still down below where it was in Nikkei in 1989, 40 years, 30 years of flat, or down actually. So they're overdue. And you see here, again, how far they're down from their high. So we think Japanese companies are cheap and opportunistic, and there could be some really good, strong momentum coming up there. We talked about value, and look how deeply depressed value is. This is a little bit better now, but not much. And so we're looking at energy sector, the financial sector, companies that are boring, that are not the kind of sexiness that you might expect for other growth companies. But what they do provide is a margin of safety, right? That's the important piece. That was always the mantra when Graham was doing his work, his seminal work in value. The margin of safety was the most critical thing, and that's what value provides you. But you're buying something worth 2x for x. And look at this. I mean, here's the opportunity, right? Here's value versus growth, and you can see how it's boom, 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 right? But look at this dispersion here, massive dispersion. So we think this is where you're going to see growth, and you've seen it already starting. Growth has come in, and values going up, and I think that's going to converge. That's called alligator jaws, right? I mean, you don't want to be in the middle of it. You want to be here, not here, right? So be careful when that alligator jaw crushes. Okay, infrastructure is part of our four eyes, and global infrastructure returns have been consistent, steady Eddie returns. We like that real asset, that infrastructure asset class. Commodities, we believe that's a beginning. That's also inflation-centric, another one of our eyes. And we believe that we're seeing the beginning of a new trend with commodities. Here's gold. I had a large base here, broke out, another base that's performing. We think that gold looks good going forward as well. And then finally, there's a lot of cash out there. I mean, so much money out there for U.S. corporations. It's not like it was in '08 where the corporations had, have heavy debt loads. We're not seeing that. We're seeing, trillions of dollars of cash on balance sheets. That's good because of two reasons: M&A and dividend growth. So you want to be careful. You want to look for that. You want to think about, hey, wait a minute, this stock is really cheap. Maybe I should just get out of it. Well, no, wait a minute. If it's so cheap, maybe there'll be someone will buy them, a competitor or a private equity firm. So you want to be aware of the fact there's a lot of corporate cash on the balance sheets, which is good. There's a safety mechanism, but I think that these companies need to grow, so they need to put that capital to work. And maybe the best way to get organic and creative growth is to buy it. So we'll see. Thank you. Appreciate your time. Look forward to further discussions. We're here to serve. If you have any questions, comments, concerns, review of your portfolio, perhaps a second opinion on a portfolio you have elsewhere, or perhaps a redo of your financial plan. Now is the time to do these types of things, to plan to go forward. And at Align Wealth, that's what we do. We keep you on that road and keep you safe and sound. So thank you, and we wish you the best, and we'll talk to you next month. Thanks very much.